absolutely no wick above, it gives us a very strong indication that the buyers are fully controlling this market right now. There is no resistance from sellers. And after a strength candle like this prints, you can assume there will generally be continued upside or downside, depending on if the candle was bullish or bearish. Now, there will be pullbacks, and of course context matters, which we'll get into soon, but ultimately it shows control, leading to further moves in that direction in most cases. When we see these strength candles, we know two things. Number one, we want to move with the strength. Number two, we want to make sure that we don't trade against it. Very simple for getting good trades and avoiding bad ones. Now, when we're looking at strength candles, as with all candles, the size of the candle body matters too, okay? We have 4 examples here, all are showing uninterrupted buying, but the largest candle is by far going to be the strongest and the best indication that the buyers are in control. A very small candle body, even if there is no upper wick, doesn't show a massive amount of buying. Yes, it shows that there pretty much isn't any selling acting as resistance, but it's not showing a massive influx of buying in the same way that a very large candle is. So a candle body that is super small, like that weakest example there, it's not going to be the strongest for determining future trend directions, even though it does show some uninterrupted buying. The big candle, however, that's the kind of thing we want to see for high accuracy moves. This is because large candles show massive buying and smaller candles show a less aggressive wave of buying. The buyers are still in control at this point, but not in massive numbers. And obviously in a selling example, we just flip this on its head. Large bearish candles are the best to see. Smaller bearish candles aren't going to matter as much. One example.
Welcome, traders. It is the moment you've all been waiting for. Thanks you for being patient. And it is Profiling for Profits with Jim Dalton. A brief introduction to the legend here. Jim Dalton has been trading for over my years, and he's the author of 3 great trading books: Mind Over Markets, Markets and Profile, and his most recent one, Markets and Momentum. I have read the book. It is excellent. But Jim, a member of the Chicago Board of Trade, as well as the Chicago Board of Options Exchange. He was the executive vice president of the CBOE during the heyday, and he has been in the markets for quite a long time. He is a legend in the markets. He is the master of market-generated information, the professor of profile. Ladies and gentlemen, Mr. Jim Dalton. Jim, how are you today?
Well, I'm feeling pretty good after that introduction.
There you go.
Anyhow, I've known John for a long time. John, thank you very much. I want to start off today with a couple of comments. My favorite author is Josh Waitzkin's. His book is The Art of Trading. Josh was international champion in 2 disciplines. 1, chess, 2nd, martial arts. His dad made one of the movies after him, Searching for Bobby Fischer. It is an absolutely wonderful book, and he is real legitimate. It's not an easy read, but you don't become the top in the world in 2 disciplines without really understanding how to learn. Josh recently interviewed an individual who's got a title of being the
Order
best
filled
lion tracker in the world. The quote from the lion tracker was, "I don't know where I'm going, but I know how to get there." I think that's probably one of the most applicable quotes to trading that I've ever heard. The markets are random. The markets are random. And when markets are random, you don't know where you're going, but you do have to know how to get there. Now, what I'm going to say now is probably going to upset an awful lot of traders. There are so many traders that are technically oriented, and I am not technically oriented. Price is nothing more than an advertising mechanism. I believe to be successful, you need to be able to read the markets as they are unfolding. That doesn't mean that I'm oblivious to the 50-day moving average, the 100-day moving average, etc. But my reliance is on the market and the information that the market is giving me right now. I do a short piece each weekend called The Week Ahead. And last week I was scanning some of the comments that the readers made. And I see some of the comments and I said, I would be very surprised if that person's profitable. One comment was, basically I'm clearly wrong. The market's going higher. The next comment was, he's wrong because we're in the right shoulder. I mean, markets don't work that way. Yes, it's okay to see things like that and view the market, but you have to have mental flexibility to go with the changes that occur in the market, and particularly in a random market environment. Now, in order to help this come to life, I want to replay yesterday morning. We'll replay yesterday morning, and then we'll take a fast look at the charts. Then we'll go to questions. Jen, can we replay yesterday, please?
Yes. We've got it queued to a minute before the open. And what speed did you want to start off at?
We'll start at 5 times normal speed.
Okay.
The first thing, as we replay yesterday, I want you to pay attention to the previous day's high. And I want you to be able to make sure you understand what the market does when it reaches that previous day's high. Now, what I think has happened here to a lot of traders, the big sharp down on the day before, and then a recovery. A lot of people, I believe, think, okay, we had a rejection. We had the rejection in the market. The market's going higher. I think what we had was a short covering rally. Now, a lot of people don't understand that a short covering rally, particularly if you're momentum oriented, the short covering rally may look fairly impressive to you. However, short covering can weaken a market. If short covering is not joined by new money buying, it will weaken the market. When the market is really short, you have to buy to cover those shorts eventually. And if you buy to cover those shorts, you are actually weakening the market because you are taking some of that support away. Short covering misleads a tremendous number of traders. Now, the next thing that happens that you need to be aware of when you open like yesterday, when overnight inventory is long or short, doesn't make any difference, but there's about an 85% chance that you're going to get a counter auction to correct overnight inventory. One of the most misleading things that occurs is when you get a correction to overnight inventory and you misread that for new money buying. So as we came in yesterday, the market is attempting to rally in here. Now remember, as we go higher, pay attention as we get up there. Pay attention to the previous day's high. Jen, speed it up to about 10 times normal speed, please. So we've opened within the previous day's range. You opened in the previous day, that is yesterday, right?
Yes.
Okay.
The 26th. Yep.
Okay. So go to 30 times till we get up to the high.
So what we're looking at, folks, is the profile just to the left of the profile that's being created right now is the overnight night before last. Or is that
Stop
last
right
night?
here. Sorry, John, go ahead.
So then what we're looking at here is the profile just to the left of the profile that's being populated right now. Is that last night or night before last?
That would be night before last.
Night before last. Okay, so the profile that we're kind of focusing on here is the profile just to the left of that, third from the right, and you see that high up there, right there. That's it. Perfect. Perfect. So it's just making sure everybody's in context with us here. All right, go ahead, Jim.
Okay. Now, one of the things, the harder it is
Order
to
filled.
take out a reference, the greater the odds that that reference will be taken back out later on. Now that's a nuance. That's a nuance. It takes your involvement. So Jen, continue to play this at 5 times normal speed. Notice how difficult the difficulty the market has of taking out the previous day's high or Wednesday's high. Now we're at 5 times normal speed. So what's happening? Short-term traders are automatically selling close to that high.
Order filled.
You know, traders, short-term traders have a tendency to buy and sell at mechanical levels. So they're mechanically selling as close
Order
to
filled.
today's high as they can get. So you see the market sells off. Now what's that doing? That's getting their inventory short. That's a very dangerous situation if there's no downside follow through. Okay, go up to about 10 times speed. You see, remember, we're at 10 times normal speed. Stop for a second, okay?
That's
So now
mechanical selling up there.
It tagged the high and one more time or one tick below it, and short-term sellers immediately sold it once again. They have a tendency to sell at exacting levels. They love to sell highs. They love to buy lows.
Mm-hmm.
That creates a tremendous liquidity inventory
Order
problem
filled.
in the market. Okay, Jen, continue to play, please. Now, we have no excess on that high. The odds of that high being taken out right now is because there's no excess. Now we're in the second half hour. See how much trouble they're having taken that out. And remember, I said the harder it is to take it out, the greater the odds that we will come back through it.
Interesting.
Look at that. They're selling it right again. Mechanical selling right at that level.
Uh-huh.
That is a very dangerous sign. Those are what you're always trying to know. Who am I competing against? When you're getting that kind of selling, you're competing
Order filled.
against very short-term traders. Those are the weakest of hands traders, and they are the ones that get inventory constantly too long or too short. Constantly selling this market is probably getting inventory very short in here. They see it once more time. They finally got it out.
Kind of busted it out.
Still selling, coming back in. Okay, now there. So now they finally got it out. We've got the stops, and now they're reversing and going to the buy side. What you're going to see is you're going to see this market go up. You're going to see it come back down several times, almost exactly to that previous high. When it comes back down to almost exact that previous high and they buy it, that is another indication of weak hands traders. Now, this is difficult because they're not necessarily wrong, at least for that moment in time.
Sure.
But the odds are that they're going to be wrong for a slightly longer period of time. Okay, so Jen, go ahead to 30 times normal speed. So you saw how hard it was to take out Wednesday's high. They got the high. Now everybody's excited and they're in there buying. Watch this market. Watch it come back down. Okay, back to short-term traders one more time. they buy it exactly or within a couple ticks of that low.
Hmm.
We're back down again, back up. This is, when I see this, I know what's going on. This is weak hands traders getting longer and longer and longer in the market. You're going to see this take place. This is one of the longest I've ever seen of where they've come down. I think they came down to it 4 times.
What time it is?
I'm sorry, this takes a little time to play out.
Order
This
filled.
is really important because these are the kind of situations that can get you in very serious trouble. If you understand what's going on, you can buy those lows with very tight stops, but you do not want to give it any real leeway. Okay, so now we've made a new high. Jen, go to about 50 times normal speed.
Yeah, if I remember, we made a few new highs there, up here. A couple
Yes,
of
we
new
did.
highs at least.
Yes, now watch this come back down again. Now we're going to play this at 50 times normal speed in order to get through it. Now you see it come back down again. Watch what they do. They're going to buy it again, almost at that exact level.
That same spot.
Okay, they're going to take it
There it
back
is.
up.
To the tick.
Take it back up very quickly. Now, what is going on here? Short-term inventory is getting excessively long. Okay, stop here for a second, Jen. Now, you just saw it go back down again. Now, what misleads short-term traders so much is this goes on for a couple of hours.
It does.
And it puts you to sleep. It puts you to sleep, and you say, well, the market's going higher. Now, what it's doing, it's not necessarily going to break, but the situation is if there's any little hiccup in the market, the odds are that it will come back through there with a vengeance. So all that
And it
inventory that they've been buying up there is getting in weaker and weaker and weaker hands. These are the hands that panic. So if the market comes back down through that, they have to sell that inventory. As they sell that inventory, that gets the momentum to the downside, and then traders jump on that momentum. And then they get themselves caught in the other direction. Jen, go ahead and play this out at about 50
Laggards.
times normal speed. So I think the
What
fourth
speed
time
do you
we
want it
went
at,
down
Jim?
50 times normal speed.
Okay.
I think we went down there 4 times. We're going to play this out very quickly. Most traders don't realize the danger that's going on. They fall asleep in this market.
Back
more
to the
time.
low. Back
Back to the low. They take it up again. This is just short-term inventory getting excessively long. A dangerous, dangerous situation. This is a result of traders that don't understand markets and how markets operate. They're simply looking at price. They don't understand anything deeper than price. But the risk to longs is huge in here. So you see, one more time, they bought it almost exactly at that level.
And there it goes. How? Okay, Jim, can you stop it for 1 second?
Yes.
Jen, thank you. At the highs there, you're often talking about tempo. There was no tempo at those highs. Look at all those even highs up there. Isn't that a little bit kind of weak as far as a high is concerned? Or do you see a lack of tempo up there?
There was a lack of tempo, but I was looking at the bigger picture. It was just
Order filled.
late laggard, short-term traders getting long, buying every
Right.
break in the market, getting themselves excessively long with inventory and not understanding how much risk they had. Now, I want to play this out all the way because you're going to see these same traders do the wrong thing
Same thing at the
again
bottom.
in the opposite direction. So unless you, if it's okay, John, we'll play through here.
Yes, please.
Okay, play it out at regular speed or 50 times.
There it goes. They trying to buy it there now.
Okay, now as this is playing out,
Uh-huh.
what is going on? These traders they're emotionally, the emotions are high, the liquidation was high, the emotions are high, everybody's jumping on that. And when you see it market spread out like this, the chances are early on they got themselves too long. The chances are they're getting themselves too short in here. Now you also have the prior low that we had from the break the other day. It did not get that out. The market stopped right there. But this is strung out. This is pure emotion. This is where traders do themselves in. And this was just, what you're going to see as we play this out. What I wanted you to feel, the
Laggard
emotion
shorts.
on the high
Uh-huh.
and understand how traders got themselves in trouble. And it takes a lot of patience because it's set up there for a couple of hours. So keeping your hands off of it is very, very difficult.
Uh-huh.
It takes a tremendous amount of patience. When this market breaks, now they get the inventory exception. They go from exceptionally long to exceptionally short. When it's strung out like this, that is usually an indication of extreme emotional selling. And if you think about when you make emotional decisions, are they usually your best decisions? No. Okay, I wanted to show this because it is just so important because these are the days that make or break you in the market. Okay, we can stop here, Jen. I wanted
Thank you,
people
Jim.
to see this, and I want you, as you remember the day they took this. They took most of this back before the
Yeah, they
day
did.
was over because they got it too short. They got it too short, and then they squeezed them all day long.
Yes, they did. Wonderful. Thank you, Jim. Thank you for that.
Take any questions you might have.
Okay. So Jim, I read the book. Wonderful book. Robert is quite an author. You are quite an author. And there was one question that I know a lot of people are going to ask when they read the book, as soon as they read the book, and it was something we talk about quite a bit here. Well, first, what is the biggest difference that you see between your third book and the first two?
Experience. If you notice, the first book had an awful lot to do with the fundamentals of the profile, forming the profile itself. We talked about how do you learn, and which is really important and still relevant today. The first book opened with the point of view of how do you become a concert pianist, and you go through 5 steps. You go through a beginner stage. The piano has black keys and white keys. You
Right.
you then get to competent, which is the third stage, meaning you can play Beethoven exactly as it's written. As you get to the final stage, expert, you and the piano are one. But it's important to understand that learning process. So many times, short-term traders, and I know from all the work I've done over the years, that the success ratio is extremely low. Most traders don't have the patience. They don't have the patience to gain the skills that they need to be a competitive, successful trader. But if you understand the first book, it goes through those learning steps. But what the first book lacked was a deeper understanding of the emotional issues we deal with as traders. And this book is loaded with, the many, many years of emotional factors that I had to deal with. And as you remember, I talk about, um, I went through a period of over 20 years where I was not profitable. I made every
Hmm.
mistake possible. I
Hmm.
I went to every indicator possible. I knew all this stuff, and that really was not meaningful to me. What was when it finally dawned on me that you have to be involved in the flow of the market and forget about the traditional technical indicators that people work with. Remember, and this is key. This is what separates me from almost all other traders. Price is nothing more than an advertising mechanism. But yet, so many people are hung on momentum. They make price everything, and
Uh,
that is a tremendous trap in the market. What I was trying to show you by replaying the early video was the importance of context. Remember, we started off in how hard it was to take out the early morning high or the high from the previous
sure.
day.
Right.
If you had good, strong underlying buying, you're
Would
going to
have
take
walked
that
right
out
through it.
right through it. And you didn't. So that was an early morning clue to me that who, when I played a lot of, I started off with handball and then I played a lot of racquetball over the years. But one of the things you always wanted to know, who are you competing against? Is it a left-hander? Is it a right-hander? How good can they hit the ceiling shot? Are they good at the ceiling shot? Or,
Hmm.
can you back it
Order
with a trader?
filled.
Who are you playing? You never played the same person twice. And when you're in the market, you're never up against the same competition. You have to constantly have some assessment of your competition and what they're doing. For example, yesterday morning, I could see that the competition was getting excessively long, and I knew that competition was weaker hands traders.
Order filled.
When the market broke, these same
Order
traders
filled.
went from being long to being short, the classical whipsaw. And as the market broke, it didn't take out the uh, the low from a couple of days ago. So we were
Right.
still within this trading range. But now they've gotten themselves from too long to too short. And then the rest
So,
of the day, you get this short covering rally in there.
so
So
Jim,
again,
is there
knowing who your
is there
competition is key.
a specific thing that you're looking at, or is it really more intuitive and experience that points out the fact that this is probably, well, you already did say, when they started buying, when it was hard to get above the